look, in hindsight, why did like meme coins take off? Why did all these things take off? Like as opposed to DeFi, which we were just talking about, that like dramatically underperformed and isn't really getting the interest that it once did. Pepe is a dominant meme on the internet. I will see it on Twitter and Reddit for the rest of my life. Like I want to be long that meme. Um, that's like kind of the defining characteristic of a lot of consumer or just consumer stuff is like eliminate friction as much as possible.
Before we get into today's episode, just a quick disclaimer. The views expressed on this podcast by either myself or any guest are their personal views and do not represent the views of any associated organization. Nothing in this episode should be construed or relied upon as financial, technical, tax, legal, or other advice. All right, let's jump into the episode.
What's up, guys? Welcome back to another episode of 0x Research. We're back today to bring you another Analyst Roundtable. Today is Monday, the 13th of May. This episode will go live on Wednesday, the 15th of May. Today, I'm joined by my co-host, Ryan, as well as Hayden, to talk about what's happening in the markets and across crypto. Today, I kind of want to start off with something that we touched up on last week, even though this wasn't necessarily happening last week. Funds and meme coins. VanEck launched their meme coin index last Thursday, as far as I know. It's a market vector meme coin index, a modified market cap weighted index which tracks the performance of the 6 largest meme coins. I know they have Shiba in this. I'm not sure what else they have in it, to be honest. Ryan, do you know exactly what's in it?
They have all the majors. They have Doge, Pepe, with Shib, and 2 others, I believe.
I don't know. I feel like we're going a bit too deep into the financial nihilism thesis. You know what I mean? I think it's a bit much. I'm like, in general, I would say as comfortable with memes as you can get. But it has Floki in it. Floki and Bonk, by the way, just for our listeners. I'm as comfortable with meme coins, I think, as you can get with meme coins. I don't know. I feel like you need to have a certain like professional lens when you're doing investing, and you want to like keep meme coins a bit separate. But I don't know. It's definitely like interesting that we're seeing this index before. I mean, they have DeFi indexes. I just don't know how popular they are.
I wonder how much of this interest or how much of this project is generated. Well, obviously, most of it's generated from the crypto native end. But I do wonder how much inbound interest they have from less crypto native participants to, track these meme coins.
Yeah, I wonder as well. I think it's become more and more less crypto native as time goes on. Like, I mean, Doge has always been a huge thing, obviously, and Bonk and Whiff did really well this cycle, and there's others as well. But I feel like more and more it's becoming a bit more institutionalized, where like this is why I said we talked about this last week as well, 2 weeks ago. But that week we had meme coin theses being written by crypto native funds. Obviously these are crypto native funds, and like they've been in this probably in their personal accounts, but it's still like becoming more and more institutionalized to the point that I'm not sure what the next step is. I mean, like obviously it can get sillier, but I don't know. Like I was thinking about this most of this morning, because this is actually not one of my topics. To the listeners, this is Ryan's topic. I don't have a like good take on this. It's just like
I have a strong take on it. I've heard a few podcasts talk about this index and what it means for the space. I think that like it's unfortunately like indices are niche for most people, but within the asset management industry, and particularly the pension fund and endowment space, who are just like professional LP investors, indices are extremely important. So the way that I view the importance of indices is like as follows. They're important for like 4 major things. Like the first is information dissemination and legitimacy. So if you So early in my career, let's say go back to 2018, 2019. If you had Bloomberg News up on your screen all day and you were watching the tickers float by, you did not see BTC or ETH during the bear market. You didn't see them. Now, or then fast forward 2 years, you saw BTC, ETH, Litecoin, Ripple. Fast forward, you're seeing BTC, ETH, Solana, and other legitimate projects, right? So like when you standardize performance measurement in the asset management industry, it gives traders another thing to trade. It familiarizes them with the space. You see that ticker float across your screen. You say, "I want to bet on that thing." So that's super important. In the pension fund and endowment space, like performance measurement is key. So this is like kind of like the second core thing I see with this index. If you are going to, let's say it's 15 years ago and you want to invest in the reinsurance space and you're offered an investment opportunity and they say it's going to annualize 10% over the next 5 years. Back then, before, let's say that reinsurance indices don't exist, that 10% annualized return means very little to you. You have nothing to benchmark against. Now that there are proper reinsurance indices out there, you know if an investment opportunity is just offering you market beta, negative alpha, positive alpha, you now have something to bring to your investment committee and say, we can achieve this hurdle rate over this well-defined standard in the market. The other thing is just like so like in the context of crypto, right? Like if you want to measure the performance of a crypto manager, you need to be able to decompose their returns and understand that they are actually delivering alpha and not beta. So what you would do is you would reconstruct their portfolio weights over time and you would assign each sector its own index, right? And you would see that if you just invested in the betas that they were invested in, could you replicate that return? If you could replicate that return, then you're not going to invest with that manager. So like, and if you couldn't replicate that return, if this fund outperformed the mean coin index, then there's alpha there. You want to invest in that crypto manager. So again, it's just like it gives these sophisticated, large institutional shops that are professional LP investors, it gives them a benchmark to measure performance, which lets them put this stuff in front of an investment committee. And then just like lastly, one very obvious mega trend, apart from just, I guess it's like a sub trend within passive investing, is thematic investing. So the RIA space is hyper focused on these like thematic investments, right? So like there are like lithium supply chain ETFs, there are like clean technology ETFs, there are cloud computing ETFs. It allows, let's say, like financial advisors to put an exciting theme into someone's portfolio with some positive expected return without them having to do too much work. And they can point to this benchmark and it's rules based and it updates and it makes investing very easy for them. Like indices had to indices had to exist first before these products could be launched. So meme coin index, like it's an index today, but as interest compounds, as legitimacy compounds, you can build an investment product on that and it acts as distribution for the space. So I think that while indices are super boring and passive investing is just like objectively boring, it is a necessary next step um, toward like these very particular institutions like touching this stuff.
I have two questions for you. I just want to hear your take on them. First of all, with the meme coin index, I mean, I assume that these get adjusted year by year, but if you consider a DeFi index that was built a couple years ago, it underperformed. Like it always does underperform, as far as I know, because like these tokens, Uni, let's say it's like Uni Maker's doing okay now, but they had that what Dejan Spartan coined the 36-month bear market. So I wonder if that will, because meme coins as well, like Floki might still have the highest market cap, but it's not like a top performer. And I mean, like if you think about it now, would you want, I mean, this is NFA, but would you want exposure to Degen, like a Farcaster base / Farcaster meme coin, or to Floki Inu? And how does that like obviously this is the reason why you measure your performance against that, because like if you can make the right choices. But I'm wondering more so, like I assume in traditional finance these don't, then the top performers don't shift as much.
Yeah, so each index has like very transparent and well-defined weighting schemes. So with this index, the max position size is capped at 30%. Because you could easily envision a scenario where the number 6 meme in this category 10 50x's whatever and becomes a dominant position in the index, and actually investors don't want that. They want a passive strategy to not be completely passive. There has to be some weighting scheme that prevents um like that prevents against large position sizes, that should manage risk effectively. And I think like the other thing that you're pointing out is like, do you want to invest in index or out of index? Super popular, like especially with like amongst bond managers, where like they most of them will benchmark to the Barclays aggregate index, which is just an index of all the US bonds that are on the market, an average of those returns. And a very easy way for managers to outperform that index is to invest in things not in that index, right? Because once a thing is in an index, like kind of like the market knows about it, there's more capital in it. There are more eyes on it. It's harder to outperform. So, yeah, and like one, you're not going to get full meme coin exposure here for sure. Like it's going to miss those tail assets. um, I imagine that these benchmarks change and morph over time, and best practices develop. But like we're very early innings, obviously.
Yeah, I assume that it wouldn't, like it obviously wouldn't outperform the meme coins. I was just more so wondering like how but I guess what you, like those 4 points that you outlined make sense. Like to me it just seems so wild that there's an index to, because meme coins are like weekly phenomena, and then eventually they might come back and there's stuff that like outperforms over time. So like as an index asset, and that's probably why like I'm being kind of a midwit right now. It's just I can't wrap my like stupid little brain around this concept that well, given that like the way that I view meme coins is completely different. But I like the four
Yeah.
reasons. Yeah.
Yeah, feels like if in another scenario, something like this happening would be around a lot of speculative cyclical top, points of the market, I feel like. But there's not really anything going on. It's just VanEck and their crypto team saying, hey, it might be useful for investors to see, I guess, yeah, how they could measure themselves against an index of meme coins. I don't really know what to conclude.
CT's been looking for top signals over the past 2 weeks, 3 weeks, maybe 2 months. And I don't think this VanEck is like very, very crypto native. I mean, they have like their own little intern that makes CT jokes, etc. I don't know how. I feel like if Pepsi was talking about meme coins and Wendy's was saying, "Oh my God, buy Doge with hat" or whatever, then that's like a top signal.
Right.
You said there's nothing happening. That's not true. Consumer crypto is happening. This is a venture coinist. I can't remember Luke's tweet, and he pointed out that Fantasy Top had more than 9 mil in revenue fees generated over the past 7 days. Frentech had nearly 5 mil, and Pump.Fun had over 3 mil in fees generated. I do not think that Pump.Fun or Fantasy.top are consumer crypto, but I think you can make an argument that they are. It's very difficult to define these things at this point, especially since they're very early. Frentech, I'm I'm not using it anymore. I feel like nobody's really using it anymore. I've been using Fantasy.top. We talked about it last week. It's a lot of fun, but I also wouldn't define that as consumer crypto. It's a game. It's a GameFi project. I think the only consumer crypto project out there right now is Farcaster. I don't know what you guys think.
I think that I would like my kind of mental model for it is just like there's consumer and then there's enterprise and then like there's subcategories within those. So given that like dichotomy, um, you know, I think that these are more consumer oriented for sure. They're definitely not enterprise oriented or oriented towards institutions. Um, so I think, I mean, look, this is you can go back to 2017 and you can read investor letters where they're talking about like how consumer crypto is right around the corner, and like the way that we kind of envisioned it. I don't think that it happened in that way and it wasn't around the corner, but there is a pretty strong argument to be made that like kind of the defining characteristic of this cycle was like infrastructure good enough to have like high frequency like consumer oriented crypto things where you could put small bits of capital at risk and play around and then like post memes on Twitter about it. Like to me that's a very consumer oriented activity, and in many ways it's been the story of the cycle.
Yeah. Apart from trying to define consumer crypto, I'm not gonna do that. But like, okay, let's assume that Friendtech, Pump.Fun, and Fantasy Top are all consumer crypto. I do think that that's what will continue to dominate over the next God knows how long. Like, let's say for the rest of the cycle, just because, like, the way that I like to view what people will be doing, let's say as a guess, is that when I'm doing these things, if I'm having fun, and that's like for a variety of reasons, if I'm like enjoying myself on Twitter, like you said, I'm buying something, selling something, I'm like, haha, this is fun, guys. B, if I'm making money on it, or like if anybody's making money on it, or if there's at least like a chance of somebody making money on it. And that's one of the reasons why I don't think, and I think most people don't think infrastructure projects will do particularly well, because it's not very easy to make money on them anymore as an investor. And see if they can keep my attention. And all three of these things have, Pump.Fun not so much, have kept my attention when I've like over sustained periods, more than I would say like a lot of DeFi has over the past year. I mean, I'm not a big perps guy, and I feel like everything happening, like exciting happening right now as applications is perps, aside from like stake and forget or farming yield. I did a big GameFi uh, like expedition over the weekend, and we can talk a bit about that as well. But I'm curious to hear how you guys like view. Is that something that you take into consideration? Are you like, okay, I'm doing this on chain, and I feel like a lot of other people are doing this on chain as well, so they're gonna keep thinking about this, and I feel like this might become a narrative, or is this odd?
I think it's an interesting way to approach, sort of like thinking about the next narrative or applications that catch a lot of people's attention. Um, for me, meme coins were predictable only because I started to see all of the MEV activity that was happening on chain and the types of infrastructure that need to be built in order for these in order for this meme coin activity to happen. And so if you just kind of like, this was last year, if you played out, how are we going to test this infrastructure? How are we going to gain feedback from the market in order to gauge or sort of lay out this path on developing systems that actually work? You'd have to think about the type of activity that would exist. And meme coins were one of the only things that I could sort of like see, happening. And so, yeah, I kind of agree with you that, um, you know, this is an activity. These are sort of behaviors that will be the driver of, this narrative, this cycle.
Yeah. At the end of the day, these are the behaviors that are being incentivized by protocols, chains, other people. Like, if you are enjoying yourself, or if you are like either financially or because you're just having fun, then you're gonna keep coming back to these behaviors, and you're gonna keep coming back to these protocols.
Yeah, I think that, look, in hindsight, why did like meme coins take off? Why did all these things take off? Like as opposed to DeFi, which we were just talking about, that like dramatically underperformed and isn't really getting the interest that it once did. I think like there's so little friction to like usage for these crypto apps. Like, what percentage of consumers like actually invest? Like, look at the 10K and like do the fundamental analysis. Like, no, they don't want to. They mostly invest on memes. Tesla is like an easy meme to get behind. It's like EVs are growing. Tesla is the big EV thing in the US. I will invest in that thing. Like, meme coins reduce that friction even further to like, Pepe is a dominant meme on the internet. I will see it on Twitter and Reddit for the rest of my life. Like, I want to be long that meme. Um, that's like kind of the defining characteristic of a lot of consumer or just consumer stuff is like eliminate friction as much as possible. You have that same trend in enterprise stuff, but it's not as important because enterprise is mostly concerned with like cost rather than friction, whereas consumers are hyper focused on the elimination of friction. And I think that all these things, um, like these speculative games that people are playing, they really eliminate friction to like taking risk. And yeah, that seems to be the defining characteristic of consumer crypto today for me.
Talking about memes, I feel like this is a pretty good example of what you were talking about, where like crypto reduces this friction. For example, GME. There's multiple coins on chain that exist called GME, and one of the things that happened today was Roaring Kitty came back, sent out a tweet, and this was kind of crazy to me because I feel like I watched the movie and I was slightly and like interested in what had happened, but I wasn't a big like GME person. And then this happened today. I don't know, to our listeners, it's the GME chart. I think it went up 100%, and it was kind of ridiculous that this happened today. And now that we're talking about it, and you're saying it reduces friction compared to Tesla. Well, sometimes this friction is forced. Like, they stopped trading on GME again, but you can't stop meme coin trading on the blockchain. And I mean, like, I feel like I say this every week. I thought like meme coins are a thing. They're always going to be a thing. I don't know. Before I was like, yeah, I don't think it's a super cycle. It's just like stuff happening. It's just like every cycle this happens. There's no meme coin super cycle. But a lot of things are getting sillier and sillier. I feel like
So yeah, my framework for thinking about this is like, okay, so why was the .com bubble so crazy? Like, one reason is that like E-Trade started around that time and reduced the friction for retail participants to get into that market. And, it showed in the stock prices. Why was COVID in 2021 like so crazy? Like, why were those financial markets so nuts? Like, one, people didn't have many other options. Um, but also importantly, the percentage of retail participation as measured by Bloomberg went from like 15% of market volume to 25% of market volume, right? And like, that's not, I mean, that's a lot, like if you think of the total dollar volume, but in percentage terms, like, people can push back, it's not a lot. Like, things went nuts,
yeah.
right? With a small change in like relative dollars from specific participants in the market, like things are, as the friction, like as one, like retail just compounds more dollars over time, like we are objectively just like getting wealthier, the middle class is growing, like as retail gets bigger, as they participate in markets more, like it's just going to get more weird.
Yeah, I agree with that. I'm gonna kind of tie this into what I was doing with gaming. Like, as I mentioned, I did like this big expedition on gaming and just trying to understand what the gaming landscape looks like. And it's the exact same thing that DeFi is facing, where we have so much infrastructure. Like, we built out all of these new chains or data availability layers, some form of way to make DeFi more efficient. But there are no apps anymore, or like there are very few innovative, new, interesting apps. And I feel like that's kind of also leading to this, because before you could at least like have some fun on chain with new apps, but whatever new app launches, it's either like it doesn't get picked up by attention, like people don't care about it.
Is the fun just making money? Like, is that what the fun is? It's that in DeFi summer, there were all these apps that were fun because we could just farm imaginary food coins.
I think slightly it is making money, but it's also just participating in something. Like at the end of the day, I think most people lose money. And I think especially on meme coins. But I think people keep coming back. I mean, of course there's the dopamine and there's the gambling, but I also think it's like you're kind of participating in something. And you're chatting in your group chat or whatever on Telegram, and you're like part of this thing. And I think there was a similar, like if you look at the biggest like DeFi projects, um, not the biggest, but the ones that became like cult phenomena, let's say, like Olympus was all about like the community aspect, free. I mean, it was all about making money, obviously. Like that's at the end of the game. Unfortunately, with most stuff, it's like that. Like all the social fi projects are also like that. But like there is some form of a community engagement element to it, and I feel like that just doesn't exist. And like there's just nothing new coming up. How I was going to tie this is it's the same with gaming. I feel like gaming is in its infrastructure phase where there's like a million new purpose-built gaming chains launching. There's very few games to play. I'm the only one I can like that I've talked about before here as well as Parallel, TCG. Project Awakening is exciting. And there's Pixels, which is apparently doing incredible stuff over on Ronin. But that's it. Fantasy.top is also another way that I was going to tie this in. Fantasy.top is a game, and I think it's probably the most successful like game launch over the past year.
I think another thing that's interesting about what's happening with crypto in terms of what aspects of crypto are catching attention from the mainstream is we're kind of bringing it back to these examples that we use, these analogies that we used to make, a few years ago when DeFi was relevant, which was there was always this analogy between some DeFi application and Robinhood, where Robinhood makes trading, the act of trading, way more accessible. And Brian, this is kind of like what you were talking about during the dot-com bubble.
Moving on, let's talk a bit about consumer crypto. Luke Martin, Venture Coinist on Twitter, he put out a tweet. I'm gonna share it now, but it's basically talking about how well some of these consumer crypto applications. I'm putting those in bunny ears because I don't think all of them are consumer crypto, but we'll talk about that later. How well these have been performing and how, such as Fantasy Top made over 9 million fees generated over the past 7 days. Frentech made nearly 5 mil, and Pump.Fun made over 3 mil. I mean, this has to be the narrative over the next 6 months, right? Like people are getting used to this idea of like, oh, if I use SocialFi, I'm having fun, I might potentially make money. And you're rewarding those behaviors, you're incentivizing that, and then I feel like people are just gonna keep coming back to that. I almost like I've been doing this GameFi report, and I almost feel like some of these SocialFi apps, or consumer apps, is a better word, have kind of replaced GameFi as the fun way of interacting and making money on the blockchain. I don't know what you guys think.
Yeah, I think I'm not one to speculate on compounding narratives. I really couldn't tell you. I don't have much of a track record doing that. But what's clear is that, like it's happening this cycle, you can go back to think pieces and investor letters from 2017, and everyone was talking about consumer and gaming applications back then. They never happened. They were supposed to be right around the corner. They weren't. In hindsight, you had an obvious infrastructure bottleneck. But I think like consumer crypto is like obviously here to stay. And the the interesting observation here is that in 99% of cases, like everything X Farcaster, where you can even argue Farcaster is part of this bundle, everything is centered around speculation.
Yeah.
Crypto enables you to take arbitrary units of value and speculate on whether those are going to increase or decrease. It is the unique property of the infrastructure that we're playing with. It was not very much existent in the internet era. It's very much, or the Web 2 era, it's very much existent in the blockchain era. I think anyone fading that trend I think that that's incorrect. I think that speculation is a core feature of these new crypto applications, and it's here to stay.
I don't know if I agree that these are consumer crypto apps,
Yeah.
though. I feel like they're mostly focused applications by which you could trade. They're just kind of they're all funnels of attention where you can trade or speculate on various coins. But to me, when I think of consumer crypto, I think of Blackbird. You could it's this restaurant app that's built on Base.
Oh, yeah. Yeah, that's also what I think of. Or like Swap, where you can like buy and sell shoes. That to me feels like consumer crypto. I get what you mean. Ryan has a good explanation.
Well, I think, yeah, I totally agree with you guys that they don't feel like the consumer experience that we're used to. But like, I think it's Mark Andreessen and Chris Dixon over at A16Z, they've kind of like coined this framework around like skeuomorphic products that like in new technology paradigms, like the first products are often very skeuomorphic. So like you could take, for example, like um, you know, like newspapers, right? Like in the 90s, like when the internet happened, like you put the newspaper on the internet and it updated once a day, just like the physical newspaper. Now, like there are interactive graphics, there's like 24/7 coverage. There are like there's videos within the articles themselves. You can share them easily with links. You can embed them in your blog. Like the skeuomorphic idea was putting the newspaper on the internet, but like like the actual big unlock was like all this new functionality. So like Blackbird to me, like I think it's cool. I use it when I can, but it's like a skeuomorphic idea. It's very much just like put the rewards program on the blockchain, and like that's going to have some unlocks. But today it's pretty skeuomorphic. I'm sure that like new features will come around and it'll be interesting. So like when I'm thinking of consumer crypto, long story short, when I'm thinking of consumer crypto, I think we have to have a more open mind to what new consumer things will be, because they're not going to look like what they used to look like. Like my framework is like there's consumer and then there's enterprise and then there's like subcategories in both sections. And like pump.fun to me is then clearly consumer. Like it is a little app within my Phantom app, and I click it with my thumb, and then in 2 clicks I can launch like some tradable asset. Like that's a very consumer like experience. So yeah, when they're finding these things, I think that we have to we got to keep an open mind, because things are going to get weird.
All right, before we move on to more questions and topics, let's have a quick word from EtherFi, thanks to our fantastic sponsor, LayerZero. All right, guys, for this week's LayerZero segment, we are joined by Mike, the co-founder of EtherFi, a decentralized and non-custodial Ethereum staking protocol. Thank you for joining us, Mike.
Yeah, thanks for having me.
Just to start us off, what is EtherFi and how do you guys fit into the Ethereum staking and restaking landscape?
Right, so EtherFi is a liquid restaking protocol that lets you take your ETH, stake it, and have it automatically restaked in protocols like EigenLayer to earn additional rewards and loyalty points and all that good stuff. However, what our ambition is, it goes actually a lot beyond staking and restaking. Our goal long term is actually to create a suite of consumer-facing applications that just make it easy for people to get access to DeFi, and that includes staking and restaking. It includes deploying capital into DeFi investment strategies, and then ultimately actually includes being able to spend that money in real life.
Perfect. How does LayerZero fit into EtherFi? How do you guys work together?
So LayerZero is a really critical partner for EtherFi. They are the core of our entire cross-chain strategy. Specifically, what LayerZero did in collaboration with EtherFi is build out our cross-chain native restaking functionality. What that means is normally if a user wants to stake or restake on a layer 2 protocol, let's say Base or something like that, they need to take their tokens, they need to stake it on layer 1, costs lots of gas fees, then they need to bridge it to Base, and then they get to use the token in DeFi. Or alternatively, what they would do is they would swap their ETH for the restake token on Base, and that incurs swap fees and typically slippage. So that's not a great experience for the user. Whereas with LayerZero, what users can now do is one-to-one take their ETH that's already on Base and natively mint restaked ETH, which is our liquid restaking token, on Base for 0 fees and 0 slippage. It's the best offer in all of staking and restaking, actually, and it's all made possible because of the magic of LayerZero and the implementation that we've built out with them.
Yeah, that's perfect. Do you guys have any exciting plans over the next 6 to 12 months?
We do, yeah. So I alluded to the our longer term goal of becoming a suite of applications. So that in the near term looks like a suite of 3 products, and those 3 products are Stake, Liquid, and Cash. EtherFi Stake, which was our first product, is a liquid restaking solution that allows you to save your ETH and earn the native interest rate of the Ethereum ecosystem. EtherFi Liquid is a non-custodial automated DeFi strategy vault. Basically, it lets you deploy your staked ETH into DeFi and earn higher yields. And then finally, EtherFi Cash is a wallet and credit card that lets you actually spend your ETH in real life. Actually lets you spend and buy stuff in real life. So between these 3 products, users can save, invest, and spend their money without ever having to off-ramp on crypto. So you basically get your assets onto crypto, you can save them, you can invest them, and then you could spend them in real life without ever having to do the dance of going back and forth between DeFi and TradFi.
Wow, I did not know that you guys were going to launch a cash product. That's actually super exciting. Thank you.
It
so
is,
much.
yeah. It's you'll be able to sign up for it shortly, in just a couple of weeks, actually.
Perfect. I'm very excited. Thank you so much for joining us, Mike. I really appreciate it. All right, let's move on. Let's talk about this KOL Round Controversy that happened over the weekend on Friday. Ryan, do you want to talk a bit about it?
Yeah, sure. So CoinDesk released an article that basically frames KOLs today and talks about the kind of controversies around those rounds. Basically, the article says a KOL that invests $10,000 in a project will hustle harder than one that is paid $10,000 just to tweet. The article mentions that KOLs often get to buy in at cheaper valuations than other investors, and they're often guaranteed or granted hefty token unlocks that let them sell faster than other investors. It mentions that this could hurt alignment, and then at the end of the day, retail is likely the ones to get hurt from this kind of activity. So yeah, I'll kick it to you guys. Thoughts on KOL rounds? Do you like them? Do you hate them? Are they here to stay? Are they a thing of the past? Like, what's going on?
I'll give my thoughts really quickly. I think like this whole KOL plus, essentially, I think we're at this area where we're kind of seeing a few like I don't know how to describe it properly, so I'm just gonna try. We're seeing like these few issues bubble up. One of them is low float, high FTV. The other one is like these KOL rounds that are very clearly very favorable for KOLs. And we also see like a few more of these issues of airdrops happening, etc., like being non-transferable. And I think they're like, each of these like individually are like annoying, but they're not particularly like vibe shifts, but like this whole thing combined, I think is going to lead to some changes over the next 6 to 8 months. Talking specifically about KOL rounds, that KOL is the worst VC that you can have. He is not in it for because I feel like VCs to an extent like justify it to themselves about why they're investing in something and why it's worth doing like a 4-year investment, because their like timelines are long and they usually don't like exit. It's most of the time it's difficult for them to exit just because of like liquidity issues, and they just have this like longer timeline. With KOLs, it's very different. You get like 50% unlock at whatever, or like 25-30% unlock. They're almost like trying to make these KOLs invest so that the investment is for free. And I mean, you just end up getting somebody who's not aligned at all, who is not incentivized to me, like that, what they mentioned, that like KOL that invests will hustle harder than one paid. I don't think that makes any sense at all. I'd rather pay. Like if I'm a project, I'd much rather pay somebody to tweet than give them allocation, because if you're giving them allocation, you're ruining almost like your price action for a little bit. Do you know what I mean? Because you're giving somebody free money and the free chance to get like a huge unlock at the very beginning. I don't know. This is like kind of unfiltered thoughts, but in general, in my point of view, KOL is like the worst iteration of a VC that you can have.
Yeah, I have takes. I think that a lot of like these kind of favorite retail narratives surrounding fundraising and crypto are kind of BS. I think like the all VCs are evil narrative is BS. I think that the high float FDV debate misses a lot of nuance. And so similarly, I think that this kind of like KOL framing misses the mark on a lot of things. This is marketing expense, and like we've been doing it forever. Like William Shatner got Priceline stock, 50 Cent got equity in Vitamin Water. Like Ryan Reynolds is getting equity for the companies that he advertises for. P. Diddy, very famously, did not get equity in Ciroc, even though he built that brand, and it was very controversial. He ended up going with to court with the company over that decision. So this is not a new practice at all. Like now, obviously, you don't want to be shady about this. You don't want to have unfair terms relative to other investors, but this is going to be there are going to be standards that develop on the market over time. So like as someone who sits in my seat, like I'm going to let the market figure this out, and I think the market will figure it out. To the point on paying KOLs in cash versus locked tokens over some time frame, I disagree. I think that it's far more capital efficient to use tokens to pay a KOL than cash, because cash is more useful to the startup. The startup will have equity, they'll have debt, they'll have tokens, and then they'll have cash, and they can only pay OPEX with one of those things, and that's cash. So you kind of want to treat cash with like the highest respect there. So tokens make a lot of sense. It also, like, if you do it right, and I'm not saying that all these projects have done it right, but if you do it right, like you want your KOLs to be aligned with your project, and a cash payment is ephemeral. Like you fulfill your contract and then you're done. Whereas a token, like there's potential capital appreciation with holding that thing, and the better the project does, the better you do. I think it's much better for alignment than a one-time cash payment to tweet for an extended period of time, because once that period of time is over, like the relationship is over and they could care less about your project. And again, like big disclaimer, I'm not saying everyone's doing KOLs right today. Undoubtedly they're not, but like the market's going to figure it out. And like from first principles, and like at the core of what this expense is, it's marketing, and it's here to stay to some degree.
That's fair. Like most of your points I understand. I don't agree with, but I think they're like fair points. The only issue is that, for example, with 50 Cent, let's say, or Ryan Gosling, etc., these are like one-time celebrities, let's say, and they become the face of the company for however long. With KOLs, that's not how the dynamic works. As far as I understand, if let's say I'm launching, I mean, they had a massive one called One Intro or something. It was just like coin launching, coin launchpad. It was like Fjord, like the liquidity bootstrapping protocol, but on Solana. By the way, they ended up going after 600 KOLs or something. And like that to me is ridiculous because you can't, because like from your point of view, it makes sense. If you are giving 50 cent, so I don't know how much they would give, but let's say 0.5% of your whatever stock to become the face of the company, fantastic. But if you're giving 600 people just a tweet about you, that to me is not a marketing expense. It's like a I'm trying to exit as soon as possible expense, which is also like for as a if I'm the protocol, it makes sense to me to do something like that. But I think it's like it's not a good approach to this whole thing. And I think it's kind of like you said, I think the market will figure it out though. I think like there'll be a correction. And that's why I like at the very beginning of this topic, I kind of rambled about how like it relates to low float, high FTV, etc. Because I feel like I'm seeing a lot of these specific trends pop up, and like on themselves, you're kind of like, oh, it'll fix itself. But like together, they're kind of becoming a bit like annoying to the point that I think they're probably gonna get washed away for a little bit, hopefully over the next few months.
I 100% agree with you, Boccaccio. This speaks to a bigger problem within the space, which is aligning incentives over multiple time frames and not, this very short-sighted incentive scheme between coins, projects, and investors. I don't know any details about how these KOL deals work. I'm sure there's obviously a lot more details that make them different from a typical, VC. But I think that you're right in the sense that the market will learn and correct the way these incentives are dealed out before, pre-token, pre-TGE. And even just like zooming out, like we live in this sort of attention economy. That's something that is thrown around quite often in crypto and broader markets. And um, yeah, I had this same sort of like kind of idea, before, which is Charlie D'Amelio, the TikTok influencer, and even Kim Kardashian. These big influencers they have their own VCs, they have their own funds. And I'm not gonna sort of I have no idea how these funds work. I don't know how sophisticated they are, but you know, I would go out on a limb and say that the value of these funds are the brand, and also I guess Kim Kardashian. She's got all the resources and all the network that she has. But going from TikTok influencer to now having a VC, in my opinion, there's like a very large gap of information that you might not have from someone who's actually like a venture capitalist. And so yeah, I feel like this sort of KOL meta has been a thing in traditional markets as well. That will also correct.
Yeah. But we're kind of seeing it already die out because now, like, if you even mention that a project has a KOL or had a KOL round, like, you get strong pushback from Twitter, from the community, etc. Like, people are actively like, I don't know how efficiently that's going to help like the market correct, but I feel like it's an easier fix than with low float high FTV stuff because first of all, some people don't think that needs to be fixed. That's fine. But if you are somebody who thinks that needs to be fixed, that's obviously way more difficult to fix because the like incentives won't correct fast enough, I think, like because VCs and protocols, they still like they why should they be upset about the system that they have where they launch at a very high FTV? And I mean, yeah, it might be hard for them to exit eventually, but they don't know that yet.
Yeah, I like at the end of the day, it's the liquid market's fault, right? Like the liquid market has to look at the private market and say like this doesn't make sense and like let that thing re-rate. But liquid market participants are not doing that. Like there's a lot of complaining about getting dumped on by VCs or KOLs, but like you had to buy it first to get dumped on. So liquid markets need to be more discerning. That's for sure. The reason that a lot of these shenanigans happens is because the liquid market is there, like ready and willing to take a flyer on it.
Kobe was talking about this on the timeline this morning, and like I think somebody just brought up that Monad. They were like, "Oh, like I hope Monad will launches at sub 1 bill." Like they were like, "I hope it launches at 200 mil or something." And then people obviously said like they last raised at 3 bill. I'm pretty sure they're not launching at 200 mil. And I think Kobe chimed in basically saying like this stuff should eventually fix itself. But like you said, if there's also like kind of this discrepancy, because I feel like we're not at that point of the cycle yet, but maybe we are. Like if stuff is launching at 20 bill FTV first day, then and private markets are raising at 3 to 5 bill, like maybe we are there. It's just this is the new thing. You just have to avoid for a little bit. But this also like this is something that I want to talk about. Hyperliquid. I feel like this is kind of related to them. This is to our listeners. They like I don't know how common knowledge this is, but Hyperliquid didn't raise at all. As far as I know, they don't have any VC involvement. They completely bootstrap the protocol by themselves. I think through fees generated or something. And the main reason that I want to talk about Hyperliquid today was because their points program ended, and they announced a new points program. But I think it suits this conversation better, where it's like, okay, is the like dichotomy of high FTV, low float going to like, how is this going to interact with Hyperliquid, which is objectively a good protocol? I mean, maybe it's not the best perp stacks, but it's a good one, and it launches, let's say, at a higher flow, it's at a more reasonable valuation. Will that be enough to show VCs that perhaps the approach that they're taking, or not VCs, but the protocols, let's say, or whoever the big guy is that decides on the valuation, if they end up launching a product, because we already know that it's a good product, if they end up launching at a high flow, lower FTV, do you think that this might encourage VCs and like whoever the big guys are to take a step back and be like, okay, like maybe there's a different way to launch these tokens. Maybe we don't need to launch them super low flow. Maybe we can launch them higher FTV.
I think it's possible. I think that in general, I like it when projects experiment with their token design. So I think the low flow high FTV is not the greatest way to align incentives for key stakeholders, including the community, over the long run. And so, yeah, I think it's cool to see projects take alternative strategies. I think that's like a really cool direction to take a risk. Now, will it change the way VCs, approach this game? I probably not, but I think that enough projects doing this, taking different approaches, will eventually lead to what is aligned among everyone in the market, as opposed to a select few.
Maybe the way I asked it was a bit too bait. I more so meant like, if people see that there are projects that are successful that end up launching with higher floats, and like not at ridiculous valuations, that maybe people will say, okay, maybe we don't have to have like 7% float and launch at 15 bill. Like we can take it a different route.
Right. Well, I think like this to me makes me feel like it gives projects the different approach, right? Rather than having to sell equity for VC investment, VC capital, you can just bootstrap with a great product. I think that is like the big difference here. You could, as a founder, create a project, generate attention. You don't have to necessarily take on VC capital. You have conviction, you have the talent, you could do it on your own. And then now you have a situation where you could distribute a token where you are more aligned with the community and not having to think about what the VC necessarily wants. I think that's so I think it can change the way founders think about this kind of like this. It does change how founders approach tokens.
Yeah. I feel like we've talked about VCs over the past few weeks. Same with meme coins. So I'm going to switch it up. Hayden, do you want to talk a bit about LVR?
I mean, it's what I've been focusing most of my time on lately, if not all of my time. What?
One second. Let's do it interview style. I'm going to ask you questions because I don't know I don't understand it. So can we do it that way? Hayden, before we get started, welcome to 0x Research Podcast. What is LVR?
LVR stands for loss versus rebalancing. The very basic way to think of LVR is every block LPs on Uniswap are quoting stale prices because on a centralized exchange, prices are quoted continuously. And so every 12 seconds, the LPs are at risk of, quoting a wrong price or an outdated price. And so LVR is the value that LPs are losing whenever the price on Binance, for example, is different from the price on Uniswap. There's some sort of sextex arbitrager who can exploit the LP's quote and make a profit with the centralized exchange leg.
I get that this is very different to impermanent loss. My question now will be, which one do you think is more important for LPs? Like, which one do you think is more significant?
Yeah, so I think, so the main difference for maybe people who aren't aware of the difference between LVR and IL, it's just the way you measure an LP's performance. And so, in my opinion, if you're an AMM designer, LVR is the better metric to optimize because it gives you more of an objective function to design an AMM. So every block, this is how much alpha that an LP is leaking. Now, if you're an LP, it might be easier for you to sort of like measure your performance because you have arbitrary periods of time where you decide to LP or where you decide to enter and exit. And so that's the main difference. LVR is measuring your profitability every block or over a period of time at distinct intervals, whereas impermanent loss is measuring an LP's performance over an arbitrary period of time where they enter a position and then exit. So I think if you're an AMM designer, LVR is what you're supposed to be, looking at. And if you're an LP, yeah, it depends on your strategy. It depends on what you're doing in the pool.
What are some key takeaways that you would like to discuss about LVR? Like, what are some cool things that you found out? What is something that you'd like to talk about more in extent?
I think LVR is DeFi and Ethereum's biggest problem.
Hot take.
Yeah, I think at the application layer. I mean, there's all sorts of problems, at the infrastructure layer that need to be solved. But LVR is the biggest at the application layer. In fact, it issues with let's say like this centralized builder market that's rising. Those are directly related to LVR. So I think that in the sense that these integrated builder searchers, are dominating sort of the MEV that takes place on Ethereum, and most of that MEV, roughly 80 to 90% of it, is coming from LVR. So in that sense, yeah, the LVR is deeply sort of like connected with these bigger problems, I guess, that the space has to think about. But in terms of like Ethereum at the application layer, yeah, it's easily the biggest. LPs continue to lose based on LVR, and we already know that shorter block times reduce LVR. So there are already chains with shorter block times that, in theory, produce less LVR. So if Ethereum doesn't sort of like figure out a way to reduce LVR, then I think over time, liquidity finds greener pastures.
I feel like we've talked about this before. This isn't very related to LVR, but it kind of is. We've talked about this before, like on our morning calls, where we talk about LPs and why they continue to LP. What do you think it is? Where I'm ignoring sophisticated LPs in this scenario. I mean, like dumb, not dumb, but like I guess dumb money who just leave their money in pools and they just like they think they're farming whatever 9%. Reality is they're down 14% on their position because of LVR, IL, etc.
So your question is why do passive LPs exist? Is that your question?
Yeah. Why do you think there is?
I think that I've LP'd. I continue to LP. Maybe not in the bigger ETH USDC pairs, but every once in a while I'm LPing, whether to farm rewards or whether I want to just create a market because there's more fees. But anyway, I think in general, the reason why I'm giving my personal experience is because I think that AMMs are strictly a DeFi, primitive. So I think that there's an aspect of wanting to support DeFi that I think LPs, share. And this might sort of like speak to, who the LPs might be. Maybe they're bigger investors that are, interested in supporting these ecosystems. And so when you think about it like that, yeah, it makes sense to sort of be an LP and then, do your best to research and design various LVR solutions. Because at the end of the day, the bigger thing here is AMMs, they're effectively decentralized passive investment strategies upon which you could like build out, you know, upon which solvers and other services can optimize returns. And so, yeah, in that sense, I think there's this longer term vision that LPs can sort of believe in, which is this hybrid between the traditional market making service and what an ETF manager would do.
What do you think about, because I feel like most people are now claiming that order books are the ideal way to swap. I think they are as well. AMMs obviously have their like strong points, especially with like tail assets, like real like stuff that you cannot like that market makers just won't touch, obviously. But what do you think is like the ideal solution to this? How do you see the AMM versus order book space shifting over the next, say, 6 months? That's a long enough time period.
Yeah, I think AMMs and order books will continue to coexist. I think that they'll continue to coexist. The interesting thing, I think this is more of a conversation of which chain could host the best AMM. Because AMMs, I mean, if you like, for example, in V3, if you set a titan of range, you're effectively, quoting a limit order.
Yeah.
So it depends. A lot of this depends, like an AMM's functionality does depend on the underlying chain to a degree. So, if we're talking strictly about Ethereum, yeah, it seems as if the space is going to have to develop auction mechanisms to sort of compete with these order books, off-chain order books, right? You could, batch swaps together into one trade that you can settle on chain, which effectively is kind of like one market order, one limit order, something like that. But we still haven't seen the efficacy of those solutions in practice, but we will.
Ryan, do you have any questions for our guest? If not, I have one more.
Is there a path on any EVM chain to an order book?
Is there a path for an order book on any EVM chain?
Yeah, like are any EVM or any teams on any EVM chains experimenting with an order book?
I think fully on-chain order book, right? Not off-chain. Fully
Yeah.
on-chain.
That's a good question. On mainnet, I'm sure there are. I mean, I should definitely know what they are, but DYDX was the big one, and they're in Cosmos now. I'm sure there are some on some layer 2s like Hyperliquid.
I think Hyperliquid's Cosmos, though. I'm not sure if they use the EVM. I think
Oh, right. We don't even. Yeah.
They use HyperBFT, which sounds like it would be Cosmos because it's Comet BFT or whatever, right?
If the ETH L1 is positioning itself just as like this strict settlement layer, like how much does it matter? Like, is this as much of a problem on the L2s as it is on the L1? And does this exist today simply because the community might not be focused on it because of that kind of long-term roadmap of ETH becoming simply a settlement layer and data availability layer?
Yeah, that's a good question. I'm not sure. I think you're right in the sense that there are Ethereum holds a different design philosophy than other chains. So I'm not sure how important order book DEX would be on mainnet, especially if they continue to optimize. If mainnet continues to optimize for things like Uniswap.
I feel like that's a good way that's a good place to end. Thank you, Hayden, for saving the pod. I appreciate it. I don't have any more questions. I'm excited for this report, though. I feel like LVR is something that I'm so far away from, even though I have an understanding of MEV to an extent, an understanding of impermanent loss to an extent. Like I understand AMMs versus order books, but LVR it's a new one. MEV Twitter keeps coming up with new little abbreviations that I just am not aware of at all.
Yeah, I think I'm like, maybe it's just my personality that I get super, not necessarily bullish, but super like fucking like passionate about the stuff that I work on. Like
Put
it
it
was
in now. You
Jito.
said we can't put it in now.
It was Jito 2 to 3 weeks ago. Now it's just LVR. Yeah, I think it's easily the biggest problem, and I think it could be solved. I think there's a way that Ethereum can optimize LP returns. But a cool sort of thing that I've learned is there are other chains that in theory already do. I think that you can have Uniswap on another chain, and in theory, at least according to the research, there shouldn't be LVR. And that's like the another thing that I realized is LVR is a function of market cap. Like LVR is bigger because ETH succeeded. So it doesn't seem like, it seems like these other chains, at least Solana being the first one, the higher Sol gets, the bigger problem LVR, becomes. But will it be as big of a problem given the same market cap as ETH with shorter block times? Those are things that the research says, no, it won't be as big of a problem. But we don't know yet because ETH has been more successful to this point. So it's like a blessing and a curse.
Apart from LVR, Solana AMMs also need to fix their entire product. They need a better product. Radium is horrible. Thank you all for hopping on to listen to 0x Research. Thank you, Hayden, for joining. Huge shout out to Ryan, my new co-host, the new co-host of 0x Research podcast. An incredible debut. I hope you all have an incredible day.